The stock market is all over the place. So today we're going to talk about some income ETFs that I love to buy when the market is rough. I like buying these at lower prices so you can get some really good discounts on the dividends. Now, these are, of course, income-focused ETFs, and I love income ETFs because, one, I want to retire someday. Two, I like to reinvest the dividends. And three, I love the idea of using monthly income to pay for things like my mortgage, my car payment, etc., etc. So that is the goal behind these ETFs. They're not growth, they are income based, but I like to use a little bit of both. So we're going to check out all 5 of these. One of them I don't own yet, but I'm looking at buying very, very soon. So I hope you guys enjoy. Remember, if you like dividend investing, if you like income investing, you are in the right place. Don't forget to like the video and to subscribe so you never miss an update and never miss out on what's new and happening in the stock market. Let's roll that intro. The first ticker of choice is the NEOS High Income ETF on the NASDAQ 100, ticker qqqi. Now, I've talked about this before on the channel, and it is definitely one of my favorites. Initially, when I first started filming content on these income ETFs, qqqi video was one of the best performers I had, and I fell in love with the ETF at that point, to be honest, not just because of the video doing well, but because so many people were interested in this, and it's pretty insane how well it has performed. Now, it has a 14% dividend yield. We're going to check out the website in just one moment, but look at the one-year chart. It's down 10%. At one point, it was down over 20%, almost 22%, but it has since then run back up ever so slightly. We were up 8% in the last 5 days, still down 4% on the month and 11% on the 6 months. So I like buying these when they're on these dips, especially the ones from NEOS. I'm a massive fan of the NEOS ETFs. I really am, and I'm probably a little bit biased, but I think I own nearly all of them or close to all of them. And I'm a big fan of it. What else can I say? Let's jump into the fact sheet and let me tell you why. So we can see all the basic stuff. It pays monthly. It has a higher expense ratio of 0.68%, which is not nearly as bad as some of the yield max funds, some of the round tail funds, but it's still up there. So take that into account. In my opinion, and again, this is my opinion, not financial advice, the expense ratio is worth what you're getting out of the fund. The distribution rate is 14.4%, which is very, very solid. And we can see the strategy down here. So it seeks to distribute high monthly income generated from investing in the constituents of the NASDAQ 100 index and implementing a data-driven call option strategy. Now, one really cool thing about the NEOS funds is their ROC, or return of capital dividends, rather than just the typical dividends, meaning you're taxed differently on them. I'm going to make a full video on it eventually. I'll talk about it more in detail, but NEOS actually does have some YouTube videos out about it, and it's really, really cool how it works. The reason I'm waiting to make a video on it is because I want to give you guys some examples and talk about it rather than just a quick excerpt about it, because it is a little bit more complicated for those of you that are not super into the tax side of ETFs, which, to be honest, is me, was me, whichever you want to say. But still, it's really, really cool, and it's going to save you money in the long run, and thus the more expensive this fund is to hold. We can see it's actively managed by NEOS, and it uses the call option strategies that may include both sold and purchased NDX index options. So really, it's just a solid fund. I love the monthlies. I love how the return has been for me so far. The dividends are absolutely amazing. I use DRIP on these because I do believe that the NASDAQ 100 is going to go up in the long term. I'm a big fan of the NASDAQ 100. It might be my favorite index. Not sure yet, but it's definitely up there. It and SPY kind of go back and forth in my brain. But it's just really solid, and that's what I like to see. And especially when I'm buying something in a market that's as rocky as this, where I'm nervous every time I'm buying something, I like to have something that has proven itself and that I don't have to worry about nonstop. And of course, you guys know I am a fan of Defiance with their ticker SPYT. This is the target income ETF. It's targeting 20% returns, which I think is very, very solid. Now, we can see that even before the market started getting all insane, this thing was trading mostly sideways. At some points, it was up a couple percentages. At some points, it was down. And then we hit November and December, and this year has just been a complete wash for a lot of these ETFs. It's still down 18.7%. At one point, it was down significantly more than that, but they managed to bounce back up the last couple days in this market. So why do I like SPYT? Consistent dividends, a very simple and achievable target of 20% returns every single year. If they can keep that up, it would be absolutely phenomenal. Let's check the website and see how they're going to do it. We can see a 20.5% distribution rate for SPYT, and they even have a lower fee, which is 0.58%. Not bad for an expense fee or expense ratio, and again, it pays out monthly. Now, this is their goal. They're not saying that they'll be able to do it 20%, but that is the goal of the fund overall. That's what they're trying to do. And we can see they have a lot of kind of with their strategy similar. It's an actively managed exchange traded fund dedicated to generating current income, and it revolves around holding shares of the ETFs that track the S&P 500 performance and engaging in the selling of daily call credit spreads on the index. So a little bit different. We can see the enhanced yield potential. This is because their option strategy involves selling a call option while simultaneously buying another call option at a higher strike. And by focusing on the short-term options, they are aiming to enhance yield compared to the traditional options-based strategies. So a little bit different, a little bit higher risk, I would say. But I kind of like it. I really do. Right off the top of my head, since I looked into this with our Investing 10,000 video into ticker SPYT, I really liked it. It's an income generating. It's on the S&P 500, and boom, there you go. And so again, it's the same kind of thing where your upside potential and downside potential is supposedly capped, mostly with the upside. The downside, we have seen it fall within these last couple of weeks of the market. And I'm really just interested in buying these at a discount because I think it could be really, really phenomenal if you're able to get a really solid yield and the price even comes back up. So you get some price appreciation as well as that monthly income. This is definitely one of the best, I think, on the market, ticker JEPQ. Now, it has, I think, underperformed QQQ by itself, but with the ability to compound those dividends, I would be curious to see how they perform in a 30-year period. It hasn't been out that long. Let's see, it started trading May 2022, and on the year, we are down 8.45%. But before that, we were up actually almost 10%, which is absolutely nuts. And since that peak, it has fallen off, still down 15%. So you're still getting quite the discount and a very solid dividend yield. But if you don't believe me, let's check their website. We can see, first of all, a much lower expense ratio, only 0.35%, up half of what the other two were. And we can also see year to date, it's down 11%. Which is wild. It has a 12.42% dividend yield, ever so slightly below qqqi, but still very, very solid, especially if you're looking at a 12% yield and a 9% return, again, before the market absolutely dropped. You can see the portfolio and how it is competitively priced compared to the peers, which I would say is very, very true. And you can see the yield, how it is definitely higher than a lot of other options, but they are missing a few that would go up here like some of the other income ETFs. I always like looking into this, going over the portfolio managers, seeing how they have been trading, seeing all the other data. It's not hugely important, some of this stuff, but a lot of it I would say is. Like this, we can see fund assets is almost 22 billion, which is massive. Daily low, daily high, market returns, discount premium, and all the other data. So they're pretty good at sharing all this stuff on here. They definitely want you to buy it so they get the fees. If you guys didn't know that, that's why all these funds are created, because they use that management fees to make a lot of money. And so they need a lot more people to buy it in order to get that fee, which is low, the expense fee, which is really low, in order to get more money. So I think that they are very competitive. I think it's a great idea. And this one, again, is on the NASDAQ 100. So less volatility, supposedly. I can see that, but tech heavy for sure. Now, before you start thinking, oh, I've seen all these before, let me know if you know of KBWY. This is the Invesco Premium Yield Equity REIT ETF. Now, this is a newer one to me for sure. It's the only one I don't own of all the ones that I've spoken about today. And we can see it took a beating, down 31%. If we zoom out to the 5-year, we can see it's been rough, and the max chart is not much better. We're near new lows, which is definitely unfortunate. But if you believe in Invesco, I like a lot of their funds. If you believe in them, you believe in the management, and you think it's going to fit kind of your investment style, it could be an opportunity to buy at some of the lowest points that it's ever seen. Now, there's a lot that goes into this fund. We're going to talk about it. But again, this year, it's just beaten up. But it did have quite an insane run prior to that. I'm not sure why it absolutely ran. From the beginning of April in 2024, it ran well over 27, almost 28%, and then has sold off again. So this one's cool. It's a REIT ETF. But if you don't understand that, let's jump into the website and see if it can explain it. This one's definitely trading at a discount. We can see the yield is just over 10%, which is very, very solid. The performance of the fund, the chart is not my favorite. It's a little bit confusing, but you can see the NAV versus the Dow Jones, fund market price, yada, yada, yada. We can also see that the 10-year, it's not been great. Since inception, it's not cooking too hot. There's a couple that have, definitely a lot that have performed quite a bit better, but I do have faith in this one because I like the idea behind a REIT ETF. So REIT is a real estate investment trust, meaning it's a company that owns a number of different properties, whether it be residential, commercial, single family, apartments, all of these different options. And then they pay, of course, based off of what their tenants are paying them. And so REITs are very solid. They're very consistent, usually a little bit lower risk depending on the real estate market. and of course, depending on the people that are paying, so the economy overall. But one thing I do think that's cool with REITs is the overall price appreciation of real estate can be very, very solid. They do typically yield a little bit lower. So this 10% yield is very, very solid in my opinion. Again, I haven't bought this one yet. I may do a full video on it very, very soon because I'm interested in all these different types of ETFs, specifically just ones that are doing a little bit better in this market or ones that I can get on a crazy discount. Now, I know you've all heard of this next one. I don't know if you hold it yet, but I'm really curious to find out. Let's check it out. Let me interrupt to let you guys know you can win some money. Now, if you guys remember 3D Capital and the interview I did with Sheldon Inwintosh, they are doing a giveaway on their YouTube channel. Now, you have to pay attention. The video is not public. It's unlisted, meaning to find it, you have to use my link below. It's going to take you right there. Then you can see all the things you have to do. It's not a lot. You have to comment, you have to subscribe, and then you get a chance to win. They're doing a giveaway of $1,000 split between a couple different winners. Definitely check that out if you guys are interested and watch that video. Let me know what you think about 3D Capital. The market has been beaten up and penny stocks are one of the first things to fall, but long term, I do still own this one. I will say I do still hold it, so maybe I'm a little bit biased. I think this is the most popular dividend ETF. Ticker SCHD. I haven't talked about it on this channel, but it did really well on the smaller channel, which I'll link down below. Again, if you guys are interested, check that one out. The 10K invested gave a pretty insane number, even though it is a lower growth dividend ETF. It yields about 3.5%, which is nothing to write home about, but the consistency with this one, as well as the potential for growth, is what really sets it apart. Now, the expense ratio, I believe, is also very, very low. We can see prior to the market just absolutely falling off, it was even doing okay in December, but before the fall off, it was still up 7%. So you're looking at a 10.5% return total, until it fell by about 10%. Now, I will say it doesn't dip like this very, very often. We did see it in 2023, but that was the last time. Since then, it's just been on a tear, an absolute tear. And so this is why I like to buy things when things drop. I know it's hard. I know it can be difficult to see red and keep buying, but I will say that I did buy more SCHD. I bought a lot of different growth ETFs because I'm just excited to see where the market can go. Let's check out the website for more details. The fact sheet is pulled up for SCHD, and we can see first off, the expense ratio is 0.06%, one of the lowest I've ever seen. Just insane. We can also see the annualized returns. The 1 year, it was 11.7%, which is very solid. But remember, the market was doing extremely well. So that is a little bit underperforming what a lot of ETFs and stocks were just doing. And now what's interesting is this is a little bit different because this is the total return of the Dow Jones US Dividend 100 Index. That's why it's different. It's not SPY. It's not the NASDAQ. So a little bit lower growth and lower dividend, but consistency. That's kind of the key with this. Holds 101 securities, and they just did their like reallocation, meaning every year they'll cut the worst performers and bring in some performers that are supposed to do really well following the Dow Jones US Dividend 100. And I'm not bummed about that. I like when they do that. They keep things updated. That's probably where part of the fee goes to, is that amount of work, but it does pay quarterly. If they shifted this to paying monthly, it would be absolutely insane. I would love it. I mean, people would buy more of it. I think they should if they can. Maybe they can't. I don't know how all the little intricate details work, but I think that could really help SCHD. But all in all, it's been solid. It's, again, safer, and when you're in these kind of markets and you just want some good, consistent dividends and some pretty solid returns, I think you can't really go wrong with an ETF just like this, mostly because everyone just loves it. And Charles Schwab, I mean, I'm a big fan of them as well. I did meet them at the ETF conference, which was super, super fun. A lot of people from there walking around, and I didn't meet like the CEO or anything, but I met a bunch of people that work there. They're very kind and gave me a bunch of good information. So maybe I'm a little bit biased, but you know, we'll see. We'll see. You can see the annual total returns. We had some insane years in 2021, underperformed 2022, bad year last year. Well, not bad, but just not great. And then this year, 2024, not too bad. So 2025, who knows what it's going to be, but again, safety in numbers, safety in consistent dividends. I hope you guys enjoyed this breakdown of these 5 dividend ETFs that I'm buying on these crazy market dips. If you did enjoy it, don't forget to like and subscribe, and let me know which ones you are going to buy or which ones you already own, because I'm always curious. We're all in this together. I like knowing what everyone else is buying and what they're doing as well, because I know this market's crazy, but we got to stick to it. We got to stick with each other. Also, big shout out to my friend Hector who gave me the link to that unlisted video. He didn't even tell me to share it with you guys, but I thought let's share it around, get some more viewers for 3D Capital. And, you know, Hector's channel, Acequisition, is really, really cool. He's a great guy. Check it out. He does all sorts of videos on there as well. Similar-ish to what I do on here, but his videos are really, they're just really well done. So check him out. I'll link that down below in the description as well. And if you enjoyed this video, chances are you're going to like these videos popping up on your screen right now. The weekly dividends have been in shambles, but we have some other options. And so I'm really excited to see what's going on, as well as with these inverse ETFs by YieldMax. Let's see how they are going to perform. Thank you guys so much for watching. Again, don't forget to like and subscribe, and I'll see you in the next video.